Amazon and Alibaba, two of the biggest winners in the market, but now the question is, of course, how are they going to continue to grow? Scott Freese is going to walk us through some of the options. He's a portfolio manager of the AdvisorShares New Tech Media ETF. He's joining us from the TD Ameritrade Link Conference in Orlando. Scott, good to have you on the program here. Let's talk Alibaba. We got some earnings coming up. What do you want to see?
Sure. I think the big thing with Alibaba is looking at the growth prospects going forward. So you have 600 million people entering the middle class in China. They opened up that cloud computing warehouse in India, so they're making inroads into India. Singles Day was $25.3 billion for them. Yeah. Every year, they just keep growing bigger and bigger and bigger and bigger. And people get concerned with the valuations and where are they, and is the stock worth it? If they come in at 1.63 on 12 billion, like, is that really going to move the stock? Probably a little bit, but if they come in at 1.69, 1.71 on 15 billion, then you're looking at a stock that's just about to explode again. Okay,
so let's talk about this because, Scott, I'm not a big technical guy. I don't know if you are, but we were just talking about the chart on Alibaba, and one thing I thought was interesting that I do kind of like to look at is momentum, right? How do you sort of assess how quickly the stock has moved higher? While Alibaba continues to post huge gains over the 12-month period, it's kind of stalled out a little bit, and it's been trading in a large part of a range until the recent breakout here a couple weeks ago. Really in the past 6 months since August, what are investors waiting for? What do they need that's going to be able to confirm if that last kind of jump higher, closer to past that 200 level, can hold?
Yeah, well, I think if you look back from the end of Thanksgiving through basically the end of December, you had all the FANG names, and I include the STAB names in that. They all kind of fell a little bit and just dead flatlined. It didn't really move much, and they've really been running up as January's begun. Right. I think the key thing with Bob is not only that they're going to beat the earnings, show good revenue growth, but when you have the forward guidance from the company and they start talking about the other areas that they're going into, they just had that the Wanda deal with a couple of the other companies over in China, getting into more and more things. They are Chinese Amazon. So basically, and they're starting to get their tentacles into everything.
So basically, it's about diversifying away from the main e-commerce line. It's sort of thinking about the same thing that Amazon is doing, which has been disrupting into different fields, talking about grocery, now talking about healthcare. For Alibaba, are the markets as ripe for disruption in their core sort of area? Because I look at Amazon disrupting here in the US, a place like healthcare, I think few would dispute it's been bloated for a long time. Grocery stores falling off the wayside, but China's in a different part of their economic growth story. Will there be as much potential for disruption?
Well, they are in a different spot, but here's why I think they have more potential for disruption. Okay. China is a hotter area and becoming a hotter area than the U.S. is with all the bloated companies that you talked about previously. So Alibaba now has this opportunity to go in, and the way that the companies over there partner with each other, and the way that like Tencent and Sina and Alibaba and Wanda, like all these different companies that will work together. And it is pseudo-political on how everything gets done, but I think the opportunities over there are much greater than they are right now for Amazon. Yeah, okay, I can see that because there's a lot of also sort of ambiguity about some of these companies' bottom lines, of course, when we talk about Chinese financials. But let's talk here a little bit about price too, because we know there's a lot of moves happening as well as within Tencent and some of the other big Chinese companies that have an online focus but want to diversify. If you're an investor and you're trying to find reasons to pay for growth, if you look at the big disruptive companies, those giants like we're talking about, is it going to be the best use of your cash? Or is it going to be a market here where investors say, you know what, maybe I'm going to find a place where they're cheaper but also have that growth? What does the price tell you about Alibaba? The price on Alibaba tells me that people are expecting this to be a big earnings beat and that they're going to raise guidance and price expectations from analysts going forward. Okay. Alibaba, I think, is the second or third largest security in our ETF in FNG. It's there for a reason, and we're not alone in thinking that Alibaba is set up for explosive growth. Just because it's gone up 100% in 1 year doesn't mean, okay, well now this is as far as you go. It's a different It's a different company, it's a different industry. And when you look at the Amazons and the Alibabas of the world, they're really in uncharted territory. They're disruptive innovators, creating new businesses, new technologies, and changing the way that we lead our lives.
Yeah.
So the opportunity for them shouldn't be gauged on PE ratios or things that we used to look at 30, 40 years ago. It should be forward-looking with what they can accomplish now and how they can continue to change and evolve.
All right, and I will say that given their valuation of the biggest competitor within China, Tencent, they don't exactly necessarily look expensive relative to their peer there. Let's talk a little Jeff Bezos here, Scott, because we talked yesterday about this big deal from JP Morgan, Berkshire Hathaway teaming up with Amazon for healthcare. But when it comes to the bottom line, what does Amazon need to do as well to continue to justify the rally? Is it going to be about numbers? Are investors going to demand higher earnings growth, or is it just about the idea that they continue to break into new realms?
I think it's a combination of both. They have to show that going into the new realms and new businesses is actually accretive to the bottom line, and that it's not just a whim or a folly. If they come in at 185 on earnings on 60 billion, the stock's probably going to sell off. But if fourth quarter earnings for Amazon or revenue for Amazon, they've missed every year since 2010. And I don't know if it's the companies getting it wrong with the guidance or the analysts are getting it wrong on the street. But this is the year that I think that's different. Black Friday was a record, and then Cyber Monday became the biggest day ever for the company. They raised the price for Prime and still added 40% Prime members, and their AWS services at a 25.5% margin is adding billions of dollars and coming out of its infancy. So their core business model that's there, it's still performing. It still continues to grow. And then you get into the pharmacies, you get into some of their other applications, you get into Whole Foods, and the other areas that they've gone into as secondary and tertiary products to just add to the revenue growth. I don't expect all of them to be accretive initially, but some of the ones that we were worried about 2-3 years ago are now really showing signs that they're adding to the bottom line. So the growth and the revenue growth is still there. It looks like it's going to continue to come. And the more that they diversify and throw their cloud and their money around and really try to be a best in breed in a couple different industries, not necessarily doing it alone, partnering with people that are expert in those different areas, it's another company that changes the way that we live our lives, changes the way that we do business, disruptive innovator, coming out with new technologies, new products. Again, I don't think you can look at a PE ratio on Amazon and say, oh, well, that's too high. It needs to come in at $2.11 on $68 billion to justify the price. It could have another blowout earnings where it goes up another 10%, and then everybody's price targets just get adjusted back.
All right, I think that's a good point, Scott. Well said, because even though a lot of these headlines sound disruptive and they sound amazing, to your point, that give it time, and so far they've been able to add dollars to the bottom line. That's what's important. Scott, pleasure chatting with you. We got to leave it there.